Understanding knockout options, an in-depth guide. Knockout options represent a unique class of derivatives utilized in the options trading landscape. These options come with specific provisions that cause them to expire worthless if certain predefined price levels of the underlying asset are breached. This article delves into what knockout options are, their various types, inherent advantages and disadvantages, and provides clarity on their functional dynamics compared to other options like knock-in options. What is a knockout option? A knockout option is a type of barrier option characterized by its built-in mechanism that nullifies the contract if the underlying asset exceeds or falls below a specified price point, known as the barrier. While they limit potential profits, knockout options typically require a smaller premium than standard options with no knockout stipulations, making them appealing for certain investors. How knockout options work. Knockout options function similarly to insurance policies. They provide a certain level of coverage until a specific event occurs. Once the price of the underlying asset reaches the arbitrary barrier, the value of the knockout option vanishes, regardless of any subsequent fluctuations in the asset's price. This unique mechanism adds a layer of complexity, especially in volatile markets. Types of knockout options. Knockout options can be primarily categorized into two types. 1. Down and out options. Down and out options enable the holder to buy or sell the underlying asset at a predetermined strike price, contingent on the asset's price remaining above a specified barrier. If the price dips below this barrier during the option's lifespan, the option ceases to exist. Example: an investor obtains a down and out call option with asset price, $60. Strike price, $55. Barrier, $50. In this scenario, if the stock price drops below $50, the call option becomes worthless. 2. Up and out options. Conversely, up and out options allow for transaction rights at a predetermined strike, provided the underlying asset does not exceed the designated barrier. This type of option is knocked out if the price moves above the specified barrier. Example: an investor purchases an up and out put option with asset price, $40. Strike price, $30. Barrier, $45. Should the asset price rise above $45, the option automatically expires, despite any subsequent drop. Advantages of knockout options. Knockout options offer a series of benefits that can align with specific trading strategies or risk management plans. Lower premiums. Compared to standard options, knockout options are generally cheaper due to their limited profit potential. Risk management. They can be particularly useful for institutions wanting to hedge risks within very tight margins. Targeted use. These options may be the choice of seasoned traders who believe the barrier is unlikely to be reached, offering potential rewards at a lower cost. Disadvantages of knockout options. While knockout options present certain advantages, they are not without drawbacks. Profit limitation. The capped profit potential can be a disadvantage for investors seeking higher returns. Volatility risks. In volatile markets, slight breaches of the barrier can result in significant losses as the option becomes void even if the underlying asset quickly rebounds. Accessibility. As exotic options, knockout options might be less accessible to everyday investors, as they generally require a more sophisticated understanding of market dynamics. Knockout versus knock-in options. Understanding the contrast between knockout and knock-in options is essential for traders evaluating their strategy. Knockout option expires worthless if a specific price is breached. Knock-in option activates as a legitimate option only if the underlying asset reaches a predetermined price, acting almost like a non-existent option until then. Example of a knock-in option: an option to purchase shares at a $40 strike price is only activated if the share price reaches $50. If that threshold is unmet, the option is non-existent. Trading options, accessibility and requirements. Contrary to common myths, anyone can trade options by opening a brokerage account. However, due to the complexities involved in options trading, brokers will typically assess your financial background, trading experience, and investment goals before approving your application to trade options. Conclusion: knockout options present an intriguing opportunity for shrewd investors looking to capitalize on potential market movements while managing risk through lower premiums. However, it is crucial for traders to understand the mechanics and risks of knockout options, as the potential for loss increases in volatile markets. By weighing their unique characteristics and overall market tendencies, investors can cleverly integrate these financial instruments into their trading strategies.